Things Money with David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from Blain Company in New Bern, here's David Blain.
Hello and welcome to All Things Money. My name is David Blain. Thank you for joining us today on 94.1 FM WNBU, or for our viewers on Cable TV 10 in New Bern. We've got an excellent show planned for you today. If you have any topics that you'd like to see on future shows or questions for me or anyone that works at my firm, feel free to give us a call at 252-633-0107. Our email is allthingsmoney@dlblain.com. And of course, you can visit us on the web at www.dlblain.com. We love to hear from our viewers and listeners out there. Let us know what your comments and questions are. So I thought today, as we approach the end of tax season, been talking a lot about taxes the past couple of weeks. As you listen or watch this, we'll be nearing the end of tax season. This year you do have a few additional days. The federal deadline is actually April the 18th, which is Monday, and not the 15th because of the District of Columbia has a holiday on the 15th. So for those of you last-minute procrastinators, you have a few extra days. But I thought today, I know I need a break from taxes myself, so I thought we would talk about something different today. I've been reading a great book. It's called The Greatest Trade Ever, the behind-scenes story of how John Paulson defied Wall Street and made financial history by Gregory Zuckerman. And it's a story about a hedge fund manager named John Paulson, who his firm made about $15 billion in 1 year in 2007. And I believe his personal take from that was about $5 billion. I'll read a few things from this book, but I'm going to tie this in because there was an article in the New York Times by Louise Story. Hey, what a great last name for a journalist, Story. Anyway, this was from Sunday, April 10th in the New York Times. It says, J.P. Morgan accused of breaking its duty to clients. And I'm going to tie this together for you back with this book about John Paulson. So in 2006, hedge fund manager John Paulson realized something few others expected. The housing market and the value of subprime mortgages was grossly inflated and headed for a major fall. So this Paulson, he was his hedge fund was in mergers and acquisitions, and on Wall Street he was really nothing spectacular. I mean, to the average person on the street, he was Harvard educated and had made a significant amount of personal money for himself. But on Wall Street, it was really a very pittance amount of money, a couple $1 million. His hedge fund, didn't have a lot of assets. And so, in terms of the whole Wall Street machine, he was basically a nobody. And colleagues at other investment banks, scoffed at him, and his own investors even dismissed him and kind of thought he was crazy. But he had a handful of investors that believed in him, and traders at his firm that they started betting against these risky mortgages and financial companies. And I don't want to go into all the details, but one of the things that I want to talk about this book is if you get it and read it, and I'll try to relay it to you, but you realize the way Wall Street works. And if you're sitting out there, at your computer and, day trading or thinking that you have some sort of advantage, your advantage is long-term, time-tested principles. And you read this book and you realize how stuff really works at the big levels. I mean, you have people with hundreds of millions of dollars that the brokers on Wall Street, they don't let you trade these type of vehicles. So anyway, Paulson convinced some brokers to trade these CDOs, or collateralized debt securities, obligations, CDS, CDOs. What he was doing was he was buying insurance on them. And so if you read about this, you say, wow, that guy made $5 billion. Why can't my advisor, why can't David Blain go out there and make me $5 million? Why can't he make 440% per year? you need to read the book, and you'll understand why and how these type of funds and how the whole Wall Street thing works. And you realize that for the average person, frankly, for the average millionaire, for the average person with 10 million or 20 million or even 50 million, these deals are not available. Paulson, put in over the course to make 15 billion, he had to put in about $1 billion. So anyway, so these CDOs, insurance on the CDOs, he was basically paying a premium, just like it says, insurance, on these obligations. And if the mortgages failed, if the people paying into the mortgage pools that the investors bought, if they stopped paying their mortgages, the investments would go down in value and his insurance would become more valuable. And so you can see it's like a tertiary type investment. He wasn't investing in, Coke stock or some stock. I mean, he wasn't even shorting things. He was buying insurance on a collateralized debt obligation, which in itself is a structured product that is tied to a set of mortgages that is tied to an individual paying their mortgage. And so you can see that it's very far removed from something you can point and click on the internet and buy or sell. And so the premise behind this was that he felt that all these subprime mortgages were going to fail, that housing was going to crash, and that by buying insurance on these products, when they did, it would pay off big. And so by the summer of 2007, the markets started to implode. Now remember, he started this in 2006, and the markets kept going along. If you go back in real estate, and there were some warning signs in the economy, but the first, sort of hiccups, there was a company called New Century Financial, and if you could fog a mirror, meaning you were breathing, they would give you a loan. And there's a great story in the book about, and you'll see these stories all over the place, about a guy, in California. I think he made like $50,000, and he was sold this interest-only arm that they said, oh, well, you can refinance it on a $600,000 house. And these people would not even make one single payment. And so what Paulson did was he went in there and he could see these mortgage pools. Once again, the average person cannot do this, but he could go in there and he could see in the mortgage pools, and he could see, the borrowers, and he could see the terms, and he could see that half these borrowers were never even going to make one single payment. Well, we're coming up here on a break. When we come back, I want to continue with the story of Paulson, and then we'll get to the story about J.P. Morgan breaking its duty to clients. So for All Things Money, I'm David Blain, and we will be right back after a short break.